All right, here's the last financial statement, the statement of cash flow. This one, as the name implies, deals with cash flow. This is a financial statement that details the enterprise's cash flow, the inflows and outflows of our cash. What is our cash doing? Where is it going? Is it coming in for what reason, or is it going out for what reason? It reveals how cash is generated and from where, and expended during a specific period of time. So again, this is kind of looking back through the entire year past or time period. There are three unique sections to the statement of cash flow. It's broken down in three specific ways. The first one being called an operating activity, or what I call OA. Operating activities are what are cash coming in and our cash going out from specifically business to business operation activities, as the name implies. So is this money coming in from my customer? Is this money going out for just basic expenses? Is money going out for inventory? Those are all things that fall into OA. The second one is going to be called investing activities, or IA. These are ones that the money coming in or the money going out from the buying and selling of long-term productive assets. So am I investing in land? Or did I sell that invested in land? Or am I investing in a vehicle for the business? Or did I sell that invested vehicle? These are all within the IA or investing activities. And the third one is called financing activities. And that's dealing with the money coming in and the money going out from financing, people financing our business. So more specifically, financing activities are the money coming in and going out from investors and creditors, much like what we talked about the end users for financial accounting. So am I getting money from an investor? Am I paying out money through dividends? Or am I paying off a bank loan? These all fall within the financing activities. Now let's look at what a statement of cash flow looks like. Again, there's our three activities: operating, investing, and financing. Again, I itemize those, each one of those. I always start with the cash received from, because that's a positive number. I want to start with positive numbers first. And then I go into, within the category, into the negative numbers. Notice this is really the only one that's had parentheses. We use parentheses rather than a negative sign. This is the first one we've really talked about so far that you've seen the parentheses, that really shows a negative number. And what that is doing is it's showing that our cash is going out. And then so if you look at operating activities, it says net cash flow of operating activities. And it's, again, pushed out to the right. It says $125,000. What that is telling me, and it's telling investors and creditors when they look at this, is that my business plan, what my business is really made up of, has made my cash go up by $125,000. Okay. Then I look at investing activities. It says a negative $5,000 as a net cash flow in investing activities. Then that lets me know the business netted a negative $5,000. Their cash went down by $5,000, but only because they're investing in something that's going to be used for multiple years. So that's not necessarily a bad thing. And then you have financing activities. I see in this one we only have a negative number, which is the dividends. But if it was a positive number, that means somebody invested in it, so we took out a loan. And then once I have my three net cash flows of those three activities, I add them up and it says net increase in cash, $85,000. That means that my total cash account went up this year by $85,000. Now, if I add to that what I started the year with, then that's going to give me my ending cash balance, and which is going to be $115,000. And again, double line, because that is the bottom line figure for this statement of cash flow. Now, the next slide I want to show you is how these things work together. And this is really important, because if you notice, I've always been really, up until the last one, I've been taking or a bit or a piece of the previous one to use for the next one. So if you look at it, this is our income statement. And when we did our income statement, we found the net income. Then we took that net income and put it into our statement of retained earnings. There. And once we did that and did the statement of retained earnings, that gave us our ending retained earnings balance. And then we did our balance sheet, and we needed that ending retained earnings balance to go into the balance sheet, which gave us our total equity. And then we did our statement of cash flow. And where it says ending cash balance, we need to make sure that that's right. So we look at our balance sheet where it says cash to make sure that they equal. The balance sheet cash balance, the 115 on the balance sheet, tells me that is what my cash is as of December 31st. The 115,000 on the statement of cash flow at the very end, that whole statement tells me where I got that 115. So one tells me what it is, the other statement tells me how I got that. And so that's how all four of these financial statements work together. That's your financial statements. That's the bread and butter of accounting.